We're live. What's up, NuView audience? This is Alex Sylvia, IRA specialist at NuView Trust Company. Today, for our weekly workshop, we're building off a little bit of my first solo webinar, Investment Types 101. If you guys recall, if you attended that one, I did my best to break down really any investment type that I could think of, whether it was real estate related, lending, private equity, cryptocurrency, precious metals, traditional investment products like stocks and mutual funds. And that presentation was really just a conglomeration of everything that I've learned by osmosis from NuView clients, and then just, anything else I've learned over my time as well. Now, today, what we wanted to do is essentially dive in a little bit deeper on one of those categories. And as you can see, we're diving a little bit deeper on real estate today. Today, we're going to be going over types of real estate investments, really the top 6 that we see NuView clients make. And like I said, we're just going to really get into the nitty gritty, the what, the why, the how, from a general perspective, right? At NuView, we're not financial advisors or tax preparers. We can't tell you what to do with your money. What's a good investment? Is this a good idea? Is this, going to affect my taxes in a certain way? We save those discussions for the professionals. We do have plenty of business partners that we refer our clients to, so we'd be happy to get you in contact with somebody like that. Now, if you've got general questions about if an investment would be valid for a self-directed IRA, that's where we can help you. But like I said, the financial advice, the tax advice, legal, all of that, it's not something we do here at NuView. So just take, this presentation with a grain of salt. While there is a lot of great information, a lot of direction that you could take after viewing this webinar, it is still said from, a self-directed IRA specialist perspective, right? I'm not in the business of giving advice. So just make sure you do all the due diligence necessary, cross your T's, dot your I's, and you'll be on your way to self-directed investing. So what is a self-directed IRA? At the end of the day, we've said it before, self-directed is really just a marketing term. The IRAs that we have here at NuView are governed by the same rules and regulations as the IRAs that you could get at a Fidelity, Charles Schwab, Vanguard, the list goes on, right? The main difference, though, with NuView self-directed IRAs is that we allow you to invest outside of the stock market into alternative assets like real estate. Now, this is very, very different from those other custodians. Those other custodians have packaged products. They make commissions off of your investment. And at NuView, we're just a service-based company. We just charge you a small yearly fee to have the account and a small asset fee for your holdings. Now, because we charge a fee, we do have services we provide, right? We still have to file forms with the IRS. We still have to update fair market values and really help facilitate a lot of these investments, because it's not as easy as buying or selling a stock on Robinhood or a very easy to use platform like that. Real estate transactions, there's a lot of parties involved. So it takes manpower, and that's how NuView keeps the lights on, right? But your investment growth, that is all yours. All the cash flow generated from your real estate investments, all of the appreciation, the power of doing these types of investments inside of a self-directed IRA is that all of those returns are free and clear of capital gains tax. And the power of being able to redeploy that capital year over year, investment after investment, is extremely powerful. So we kind of already covered this. What are the benefits of self-direction, right? We already talked about the tax savings. You have the same, tax savings as you do with any other IRA or tax sheltered investment vehicle. You'll never see a dime of capital gains tax again. And then if you do your investing in the right type of IRA, you might not even have to pay income tax when you start taking distributions at retirement age. Now, outside of just the tax savings, you can diversify further beyond what the stock market has to offer, right? Into a lot of different assets. And we're just touching on a couple of real estate related ones. But if you guys want an idea of what you can do with a self-directed IRA, go check out the webinar I did a couple of weeks ago, Investment Types 101. It's basically anything I could think of, and the list is pretty endless, right? But your job as a self-directed investor, it's to invest in what you know best, which you see is the third benefit of self-direction there, right? If you've got a skill set, if you've got an interest, if you've got involvement in your local community, even, you could put your IRA dollars to work in something that's not a Coca-Cola stock. Do you really know what your dollars are going towards when you invest in the stock of a company? If you invest in a mutual fund, do you even know what companies that mutual fund holds? So there's a lot of things to consider when you're considering investing in traditional products versus, alternatives like real estate. But the number one benefit is always the tax savings. And then very close second is being able to really focus in on something that you might have an interest in, right? If stocks don't interest you, if doing fundamental analysis and looking at, quarterly expense reports and earnings reports doesn't interest you, but hey, you've bought a house before and you kind of understand what that process is like, well, you can just do it in an IRA and never have to pay capital gains tax again. And again, in the right type of account, maybe never have to pay income tax either on that money. So there's a lot of benefits to self-direction. And at NuView, we've got a couple of different ways that you can go about it. So the types of plans that we have here at NuView, they're all listed here. We've got them in a couple different categories. The personal plans, as long as you have earned income, you can open up a traditional IRA or a Roth IRA. The employer plans, those are reserved for self-employed people, and which one of those you might land in if you are self-employed does rely on if you have employees, maybe the size of your company. Always reach out to us if you have questions about which one might be right for you. And then we have our specialty plans as well. And these ones are cool because these are the use now plans. These aren't ones where you have to wait until a very specific age of 59 and a half to start using these funds. These are ones where if it's for qualified medical expenses, you can use that HSA. And if it's for qualified education expenses for a child, you can use that ESA. And those both have very unique tax benefits as well. And the health savings account in particular, it almost has a double tax benefit. If you qualify for an HSA, which really you just have to have a high deductible health plan, if you call up your provider and ask them if it's HSA compatible, they'll be able to tell you. But the cool part about the health savings account is that when you put money into a health savings account, you're able to take a tax deduction for the amount that you put in. But on the backside, when you start taking money out for qualified medical expenses, it does come out tax-free. And if you know IRAs, if you've hung out for a few of these webinars in the past before, you know that it's essentially a traditional IRA going in and a Roth IRA coming out, that health savings account. It's got a double tax benefit on both sides. Very powerful investment vehicle there. But like I said, these are just all the different methods that you could essentially be saving taxes on your investment growth, right? So a lot of times people want to maximize their tax savings, and a lot of times people will also qualify for, more than one of these types of accounts. So see what works for you, talk to that CPA, see where you're at as far as your tax liability, and just know there might be some strategies for you to further work down your taxable income. Now, with self-directed IRAs and IRAs in general, there are some rules that come with investing, and we do have some restrictions that we have to keep in mind. Number one is the people restrictions. The IRS does not want your IRA transacting with certain people, and we call these people disqualified persons. Very specifically, these people are your lineal ascendants and lineal descendants, as well as any spouses of those people, as well as you and your spouse as well. These people are restricted from buying, selling, trading, loaning, or extending services directly or indirectly with your IRA or vice versa, right? And that's also the transaction restrictions you see there. The two kind of go hand in hand. Transaction restrictions happen with people restrictions. And investment restrictions, this is a very, very short list, right? The IRS, they say your IRA cannot invest in life insurance contracts or collectibles. Outside of that, if you can put a title to it, if not with a disqualified person, your IRA, your 401k, HSA, or ESA can hypothetically invest in anything under the sun, like I said, except for life insurance contracts and collectibles. So again, going over the people restrictions, very, very specific. That's what you got right there. Transaction restrictions, like we said, you can't buy, sell, trade, loan, or extend services directly or indirectly with a disqualified person. Now, I will make this note too. Something that does occur occasionally is somebody might list a friend or a brother or a sister as a beneficiary of the IRA. Now, before they were listed as a beneficiary, they don't fall in that lineal ascendant or lineal descendant category. But as soon as you, the IRA owner, list them as a beneficiary, that person now becomes disqualified. And that's why those people are disqualified in the eyes of the IRS, is because those people are likely beneficiaries of your IRA. And because of that, they have the same fiduciary responsibility towards your IRA to always act in its best interest, which is why the IRS restricts self-dealing your IRA to yourself by transacting between you and your IRA, or between your IRA and any of those other disqualified persons. Then we talked about the investment restrictions already, life insurance contracts and collectibles. Collectibles because they're hard to value, and the IRS wants regular market value updates of IRAs. That wouldn't work out that well. And life insurance contracts, they do pay out when somebody dies, and the IRS just does not want that type of investment inside of an IRA. Simple as that. So right here, we've got a quick overview of NuView's proven process. There's a lot here. I'll boil it down to 3 steps. You open your account, you fund your account, and you invest your account. It really is that simple. And even the investment side of it, I don't want you to, be concerned if, just because you're doing something in the name of your self-directed IRA, it doesn't make the process all that different, especially with the real estate transactions. All of the same parties are still involved, right? But now, since there's a different name on that buying contract, and now there's a different name on the title of that property, that just means that somebody else has to sign off on it. But what's that name that's on the title now? Well, it's not yours, it's your IRA's. If your IRA was at NuView, which we hope it is, that would be something to the effect of NuView Trust Company, FBO, for the benefit of your name and your account number. That's the name of your IRA. Your IRA is a separate entity from you. Now, because that's the name that's on the title, that's the name that's on the contract, that means that you need a NuView representative, AKA your custodian, to actually execute those documents and sign on behalf of your IRA. We still won't do anything without your written instruction, right? But that is an important step to note. But the silver lining of that, it is different, yes, but what it also tells us is that the process really isn't all that different than making these investments outside of an IRA. It's just a name change, and because of the name change, somebody else has to sign off on it, right? Real estate, it does come with a little bit extra rules just because there's a lot of nuances with real estate investments, especially the type of real estate investments that you make, that we'll cover in more detail as this presentation goes on. Now, just as a general overview, like I said, that webinar I did a couple of weeks ago, it's a great resource as well. But right here, this slide is kind of giving you a good synopsis of what NuView clients are investing in. This isn't an exhaustive list. Like I said, the IRS only tells us what we can't invest in. Can't, right? They don't tell us what we can invest in. So basically what you need to do then in that case is, look at what's out there. I like to say, keep your head on a swivel, because in the world of alternative investments, everything's an investment. On my way to work every morning, on my way to NuView headquarters in Longwood, Florida, my head is on a swivel looking at shopping plazas left and right, just because my perspective has shifted in the last year. You're not limited to just the stock market. There's a whole world of investment options out there for you. And like I said, if you've got an interest, if you've got something that you've already developed a skill set in, there's no reason why you can't take advantage of that skill inside of a tax sheltered investment vehicle like an IRA or a 401k, HSA, or ESA. It's available for you. Your job as the entrepreneur, as the self-directed investor, is really just to hone in on something, really focus and dig in. Really don't try to be the jack of all trades and master of none, because you'll just run yourself ragged and never take action. And that's always the biggest barrier. People plan and plan and plan, but there's this thing called paralysis by analysis. You just study too much and you try to learn too much that you just don't take action, right? So the way we counteract that, though, is figuring out what your interest is. What do you see as something that you could, really enjoy or get excited about? And then know that you have a resource at NuView to be able to make those types of investments tax sheltered, free and clear of capital gains tax. So today, I know we've been, struggling to get here, but, going through those, first couple slides is always good, especially for the new investors out there. But today we are going to be digging in on real estate investment types, specifically the what, why, and how of the top 6 real estate investment choices of NuView clients. So we're going to be talking about rentals, AirBnBs, fix and flips, syndications, unimproved land, and offshore real estate, the what, the why, and the how, and what might be some things to consider, as well as things to consider for doing these types of investments in a self-directed IRA. So specifically for the what, we're going to talk about the overview of the specific real estate investment type and what's involved. Why would an investor consider this real estate investment type over another? How is, generally speaking, how an individual or an entity like an IRA could invest in these opportunities. And I will say this too, like I said, we're not the investment experts here. We're not financial advisors. So this is, and I'll be honest with you guys, this is coming from a 27-year-old, as much as you probably can't tell. I don't have a ton of experience in the investment world, but what I have had is a lot of experience over my time at NuView, hearing from thousands of NuView clients, probably at this point, all doing different things. And it's really opened my eyes to what's out there. And I'm just trying to convey that message to you so that you can, again, find something maybe that interests you, sets that light bulb off, that you just want to get involved. And once you have an idea of, where you need to direct your efforts, which I hope this presentation gives you, then you're off to the races, right? And now then my job is done as the IRA specialist, setting you up for success, letting you know what's available to you as far as the tax sheltered investment vehicles. And while I can't give investment advice, maybe at least just nudging you in the right direction based off of what you're already interested in. So let's just get right into it. So arguably the most simple, I'd say the most digestible form of real estate investment is single and multifamily rentals. This is because majority of people, they've either been a renter or they've bought a house and maybe later rented it out in their own personal name, right? So this is just, like I said, at least in my opinion, the easiest to digest because most people have experienced this, this situation before, whichever side of the table they were on. So like I said, we're going to go over the what, why, and the how. So what's going on here? Single or multifamily residence rentals. So we're talking about a single family home or a multifamily home, something like a duplex, triplex, or quadplex. And the investment itself is simply buying and holding that property for the sake of collecting the rental income primarily. Obviously, over time, you hope to see some appreciation as well. And that's part of the why. So there is cash flow from renters. There's the possibility of long-term appreciation, and it's arguably passive compared to other real estate investment types. Now, as you'll see on the right-hand side over there, I decided to put in a little activity meter, which is good for you self-directed investors out there. The IRS likes to see passive investments inside of an IRA. And that's not to say that the more active types are illegal or wrong to do in an IRA. There's just more that could go wrong, or more that the IRA owner might do that could bend the rules, break the rules. And it's just something, again, that as the IRA specialist just want to convey to you, my interpretation of these different types of real estate investments and what your considerations should be. Again, not exhaustive. So single and multifamily real estate, it is something where you are going to have to either be a landlord or hire a landlord. You have to, be a homeowner, fixes, construction, rehab, simple collection of rent, that all comes into play. So that's why I put the activity meter kind of in the middle there, because as far as the investment itself, outside of servicing that investment, you're not really, doing so much. It's not a fix and flip like we're going to talk about soon. It's not that type of activity, right? But these opportunities, single and multi-family residences, how do you get invested in them, right? And this little section right here, this is why I decided to do like a little 1, 2, 3, kind of step process, right? And again, just from my experience and the investors I've spoken to. So first you want to locate your property, and this can be done a few different ways. You can either go to local real estate investor association meetings, which is the RIAs you see there. It's an acronym. And at these meetings, they have them generally on a monthly basis, but a lot of them also have weekly meetings as well, where they'll teach on real estate investing topics, but it's also a networking opportunity for those real estate investors there to network and possibly find opportunities as well. There's also bandit signs, which are the ones you see, just outside driving around town, stuck in the side, kind of like yard sale signs. It's worth reaching out. It's an investment. It could be a deal. Usually those people putting up those signs might be wholesalers, people who are just getting properties under contract and then selling the contract to the end investor. There's Facebook groups, which are honestly great. It seems a little weird to be going on Facebook to try and find investment opportunities, but city by city, especially if it's a hot real estate market, there are very, very active Facebook groups out there, and people post their leads all the time, whichever end of the spectrum they fall on, whether they have a property to sell, whether they are looking to buy a property that has certain qualities. It's all different sides of it. There's a world of resources out there. So realistically, just go to that trusty google.com and, you can find a lot out there, but these just a good couple of places to start. Just know that it's not all of it, all that's available to you. Number two, you want to evaluate, right? So you're going to have a purchase price if you're going to buy a property. You want to make sure that you are buying at a discount. And again, from a lot of the real estate investors I've spoken to, they say you make money when you buy, right? If you're buying and you're paying, significantly more than would be compared, the actual value or a fair value of that house, then you're going to be essentially for the lifetime of that investment trying to dig yourself out of the hole to, get to break even, hopefully get to a profit, but who knows, right? So that's why the approach is very, very important, with most types of investments, but real estate very, very specifically. So do the math, if you want to as well, you should probably have the property inspected by a professional. And it's really just to make sure that, the price that you and the seller have agreed upon is a fair price, is a price that you'll be able to springboard that investment off of, knowing that you've already gotten a deal up front, not worrying about, the appreciation of the market over time, because what you want is, and that's kind of the whole purpose of, investing in rental properties. It's, the appreciation of it is just the cherry on top. Where the power comes in is that regular cash flow from having the renters, right? And with that, there's some other considerations as well. So I do want to get into the things to consider and keep chugging through this presentation because we got 5 more to go through. But things to consider for single and multifamily real estate: location, location, location. Right? If you're looking for a rental property, you don't want to buy a rental property that, is off the beaten track, that's going to struggle to find renters. You want it to be located in, an area that's got, a healthy population, a healthy workforce, just to be sure that the primary purpose of your investment, that cash flow, is able to be regular and not have any interruptions, right? Of course, number 2, did you negotiate the best possible price? Number 3, this is also almost as important as the location. Will you be able to keep the property rented? And this is why people might diversify and decide to invest in some multifamily opportunities rather than just single family. While those both are, real estate investments, and maybe at face value, you wouldn't call that diversifying, but the number of doors is a way to diversify as well, because as people graduate from single family and they maybe want to diversify and not have to worry so much about keeping the property fully rented, because, if you have a single family residence and your renters, they leave, you have to pay vacancy. It's going to be a monthly cost for you to be able to take over, that mortgage payment that the renter would, previously have been paying. Now, if you diversify into multifamily, something with multiple doors, now if you have 4 doors, like a quadplex, and one of those renters leaves, you still have 3. You're not having to foot the entire bill for the mortgage. You still have those 3 other renters helping. So that's something important to consider as well with your approach. And number 4, do you plan on using any financing? So this is going to come in a little bit more on the notes for self-directed IRAs, but obviously on the personal side too, Obviously, if you need to use financing, that's a discussion that you're going to need to have with a financial advisor, working with a loan officer. That's an entire different beast itself that I'm not the knowledge on. It's a question to ask though, because ultimately your buying power is going to affect the property you're able to purchase, the location that you're able to purchase it in, and all those things obviously will determine the success of the investment over time. So notes for self-directed IRAs. Obviously, we're dealing with self-directed IRAs. You have prohibited transactions that you have to look out for. And as we spoke about in the introduction to the presentation, prohibited transactions occur with disqualified persons or disqualified parties. When it comes to real estate, and just to reiterate the rules verbatim, you cannot buy, sell, trade, loan, or extend services to or from any lineal ascendants or lineal descendants, as well as their spouses, as well as use the IRA owner and your spouse as well. Now, again, if somebody becomes a beneficiary that falls outside of those ranges, that person is also disqualified as well. When it comes to real estate, though, obviously, when we say we can't buy, sell, trade, loan, extend services, yada, 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 very simply, somebody could easily understand I can't buy a house from my son or my daughter. I also can't sell a house from my IRA to my son or my daughter. But where the other side of it comes in is that your IRA, it still has benefit that's supposed to come at retirement age. That's why there are these rules, is because the IRS doesn't want there to be any instance where you could be perceived as taking an early benefit from your IRA. And just like your IRA has beneficiaries that would inherit the IRA, so do your disqualified parties, those lineal ascendants and descendants, they also can't take early benefit from your IRA's investment. What that translates to for real estate is that you, the IRA owner, your spouse, and any lineal ascendants, descendants, spouses, beneficiaries of your IRA, none of them can take benefit from your real estate property either. That means renting the property. That means using the community pool that property lies within. Indirect or direct, you cannot take benefit from your IRA's investments. This extends to, and we'll just blanket statement it at this point, family members. Your family members can't stay at the property, take indirect benefit. They can't use the pool. They can't go hunting in the backyard if it's got a nice expanse out there. That was just one specific one that came up a few months ago. So are those rules that you have to deal with real estate that you don't have to deal with something as simple as Coca-Cola stock or Walmart stock, any of those, right? And that's why the education component of self-directed IRAs is so heavy, is because there's a lot of rules that apply that don't when you're not using something tax sheltered. Rules that apply that don't because with an IRA, you have a fiduciary responsibility to that account. So do your beneficiaries. So do your lineal ascendants and descendants and spouses. Now, number 3 on the notes for SDIRAs is UDFI, unrelated debt financed income tax. If you plan to use bank financing to help your IRA to purchase an investment property, we always recommend talking to a tax professional about unrelated debt financed income tax. What that means is yes, there is a point where your IRA could become a taxpayer. Which sounds crazy. We always talk about how IRAs are, a way to get, free of taxation, right? And ultimately, there is a tax, capital gains tax, that you can get away from, right? But what happens when you use bank financing to purchase an investment property, or really any investment whatsoever, is you're bringing in outside money from outside of your tax shelter, right? And that money's not going into your tax shelter, it's going straight to the investment. So since those dollars, those technically aren't tax shelter dollars, the work that those non-tax shelter dollars do is taxable. And by the work, I mean the net income that's generated from that real estate investment property. So that cash flow on a monthly basis would normally, to a percentage extent that you're loan financed, would be taxable. And to make that really easy, we're going to use easy numbers. Let's say you have $50,000. You see a property that's for sale, it's worth $100,000. Your IRA needs to go and get a loan for $50,000. Now, $50,000, that's not tax sheltered dollars. So when you put all that money together, you buy the property, you fill it with a renter, and it starts spitting back out income at you. You have to be aware that your loan financed percentage of the net income is taxable. So if you financed 50% of that purchase, as we just laid out with those easy numbers, then your taxable, the net income would be taxable. 50% of that net income would be taxable. So again, it makes a little bit of sense. That's not your tax sheltered dollars. So those gains, that net income that those non-tax sheltered dollars generate is going to be a little bit taxable. So it's just something to be aware of, not scared of. When you think about it from that perspective, that it's not technically your IRA's dollars that are doing the work, it starts to make a little bit more sense. And also a silver lining that comes with it is once your IRA becomes a taxpayer, now you can use that same 50%. You can use that same 50% of expenses and other tax write-offs as well. So again, something to be aware of. Don't freak out about it. Consult a tax professional. They'll do the math with you, and you'll likely be surprised at how scared you got when you didn't necessarily have to be. So next on the docket, we got Airbnbs, and this one's really, really popular. Definitely something that's been more developed in the last couple of years. We had a great presentation out at our investor retreat earlier this year from a group of guys out in Tampa that do primarily Airbnbs. Jason Matthews, if you're watching this, great presentation out there. But short-term rentals, they do have a little bit extra that single or multifamily rentals might not have. Right. And so if you're not familiar with Airbnb, some of the other platforms exist out there as well. It's essentially a platform where you can go and list a property that you own open for rent. And it's almost like a hotel type basis where you can play with the length of the stays. People might use the property for one night. They might use it for 10, a whole month, 6 months if you have that availability set. But it operates differently than a single family rental. And the main way that it operates differently is in the rent that you're able to charge for short-term rentals versus medium to long-term rentals like you do with single and multifamily real estate. Obviously, our clients are setting the rates, I can't tell you what's average because I don't know, but I do know that it's significantly more than what you would get for a rental, just by the sheer nature of the shorter terms, higher turnover. And I actually was speaking to a woman a couple of weeks ago, and she calls her investments her game day rentals because she's very strategically picked out properties that are nearby college football stadium so that she gets all of the traffic on game day weekends. And according to her, she's raking it in. So Airbnbs, definitely, if you're already kind of feeling the single or multifamily rental space, I feel like Airbnbs are at least worth a look for you because it's really just getting familiar with the platform. What does the upkeep look like and things like that. So we really did cover a lot of the what and the why there. We've got, the cash flow from the renters, just like single and multifamily rentals, long-term appreciation of the asset itself, but then you also have the higher income potential just by the nature of the rates that are charged for Airbnbs or other short-term rentals. So going on to the how, basically the first 1 to 4 steps are the same. You're going to locate, evaluate, inspect, and then act, right? We got that little acronym there. I knew I put it in there for a reason because I was going to forget, right? And then you got to just get familiar with Airbnb's platform and you want to list it there. You're going to need to manage bookings after that and also manage the upkeep. So things to consider, again, location, but you get bonus points if you go for the beaches, sports stadiums, other venues, but you do want to be aware of zoning laws. We have had a couple clients that were operating short-term rentals in areas that were not zoned for them. And it did end up being a case where they were, getting fined, month after month or however long, it was for. And it's just not a situation we want you to end up in. So just be sure if you're going to be doing this type of investing that you check to make sure that you're allowed by, the county ordinance or whoever makes these rules that you can operate a short-term rental in that area. Again, number 2, did you negotiate the best possible price because you make money when you buy? Who will be doing upkeep? And this is important too, because you're either going to have to drive to that property yourself and clean it after every visitor stay, or you're going to have to outsource to a cleaning company. So just something to take into consideration with Airbnbs that that you definitely wouldn't have to with single or multifamily rentals. Again, number 4, do you plan on using any financing? Always a question when you're getting involved in real estate investing. There's different types of loans out there. So it's just something you do want to keep in the forefront of your mind. So, number 1, what type of property you're going to be able to purchase? Are you going to be able to afford a certain location over another? And then in the case of self-directed IRAs, the same rules we just talked about also apply. Prohibited transactions, disqualified parties. And then if you plan on using any financing, that pesky UDFI will be there to rear its ugly head. But like I said, that's saying a little bit too much, because we actually did a great webinar a couple months ago too with a CPA, Adam Barr, out of Texas. And he did such a deep dive on UDFI that it does not seem like much to worry about. So always get that A-OK from the tax professionals, but we just want you to know, be aware of it. Don't be scared of it. Now, one thing that's unique with short-term rentals versus medium to long-term rentals that you get, that we just previously talked about, is UBIT that you see there on number 3 under notes for SDIRAs. UBIT stands for Unrelated Business Income Tax, and it's generated from UBTI, which is Unrelated Business Taxable Income. They're not really one and the same, but they kind of are. It's really confusing. It's CPA talk, and I'm happy that I've at least grasped it. But really, the important thing to take home for you self-directed investors out there is that if your IRA's investments mimic business activity, then you might be subject to taxation on that income. Now, the way this relates to short-term rentals is that if the rentals are so short-term that it almost mimics a hotel where you are having people stay, between 1 to 3 nights. And I hesitate to say numbers because unfortunately, since Airbnbs are so new, there's no finite number that the IRS has given us that, says if your renters, your short-term renters stay less than 4 days, this is going to be considered business activity. It just doesn't exist, right? So this is why we always say consult with the tax professional. If you don't have to do that short term of rentals, maybe don't. Maybe it's just not right for your self-directed IRA at that point, because you want to protect those tax sheltered dollars. You don't want to do something that is gonna trigger a taxation that's gonna reduce your returns over the year. Or after you've sat down with that CPA and maybe have worked out that even if you're gonna trigger that UBIT tax, that it still makes sense, then maybe it still does, right? But like I said, we want to make sure that you just know the right questions to ask as you approach these types of investments so that you're the most prepared and most well-equipped self-directed investor you can be. So that about wraps up Airbnbs. I didn't, though, however, touch on that activity meter there, right? And I'll just switch back for a second. It is in the orange spot. So that means that it is a, 1 tick more active than rentals. And the reason I did that was because you now have to worry about upkeep, right? You have to manage bookings. There is a bit more activity that you may not have to do with single or multifamily real estate. So fix and flips, and we're going to get this one out of the way just because this is the most active, right? This is about as active as you can get, because there are people that do fix and flips that might outsource the construction, or there's those people that want to do the construction themselves. So this is arguably the most active, at least in my eyes, type of real estate investing you could do. And what is it specifically? This is the purchase of single or multifamily residence, purchased ideally at a discount for development, rehabbing it, and ideally selling it for that spread in the price. Spread between you identified it as maybe a distressed property, maybe you got it at an auction, very, very good discount you bought it at, and you see the value in installing some new carpets, maybe painting the walls, new roof, whatever it is that you see as some value adds, doing all of that and then selling it for a profit. Now the spread can be relatively large, which is why a lot of fix and flippers like this type of real estate investing, because this is one where it's even more important to negotiate the best possible price, to make the money when you buy, because that spread is where you make your money. And it's important to note, though, that spread, it's captured after repairs. So there is going to be a lot of labor that's involved. This isn't necessarily something for the faint of heart to get involved in. There's going to be a lot of moving pieces. And if you're trying to do this type of investing with a self-directed IRA, it's, more often than not, sometimes more trouble than it's worth, but it is something that NuView clients do, and they do successfully. And they might have to outsource more of it because the IRS does not want the IRA owner swinging the hammer in any sense of the word. But it does have a different why, compared to Airbnbs or compared to single or multifamily real estate. And the why, again, it's, you're capturing that spread. And realistically with fix and flips, I don't think I've ever heard of somebody doing a fix and flip that took more than, a couple months. So it's a very short-term investment type. It's a lot of work jammed in there, but you're able to redeploy that capital maybe a couple times during the same year. So it could be right for the right person. Redeploy the capital, power of compounding interest just gets all that more powerful. The how, essentially the same, except we got the added 5 and 6. You fix the property and you sell it. So things to consider for fix and flips would be who's doing the repairs. Again, the best possible price. Did you negotiate to the best possible price? Will you be able to find a buyer, or maybe do you have a buyer in mind before you've even gotten started, right? And this is all, again, about the approach with real estate investing. It's not simply like buying stock, and just, averaging in over your lifetime. This is something where for the investment itself, since there's so many moving pieces, so many different ways that you can, ensure that you get a good return on your money, you do want to make sure that you're crossing all those T's, dotting all those I's. So if you can find that buyer ahead of time, or at least have a network of buyers, and this is where those real estate investor associations come in handy, is you want to be able to have those people ready. You want to have an idea of, who's in the business of getting properties under contract. Would you be able to buy a property from them, fix it up, and then sell it to the end investor who's just looking to rent it out? That's why I say these real estate investor association meetings are very, very valuable, because number one, you get a network with these people, but if you're new, you also get to learn from them as well, because they'll present their experiences. Sometimes they might even offer to, give you a little bit of mentorship. Definitely a wealth of knowledge at these real estate investor association meetings. And, really whatever type of real estate investing you're looking to get involved in, it's highly recommended that you get out to one of those. So I do want to get into some notes for self-directed IRAs. Again, the prohibited transactions and disqualified people, that's still in play here. And UBIT and UDFI come into play as well. UBIT, again, the IRS does not want to see something that mimics business activity inside of an IRA. Didn't do such a great job of explaining why before, but it's really just because they want to level the playing field. If I opened up a pizza shop in my IRA and I went and I built it right next to a Pizza Hut, I could undercut them and drive them out of business. And the same goes for you and your IRA. The IRS doesn't want you mimicking business activity out of a tax shelter when, those of us not using an IRA, we're going to get taxed as individuals. So it's just a leveling of the playing field there. Just like short-term rentals, there's no finite number on how many fix and flips might trigger UBIT. So again, consult with your tax professional, consult with financial advisors. More importantly, though, and I'll always say this, is, your IRAs are precious tax shelter dollars. You spent probably many years at an employer building up that 401k and then rolled it over to an IRA, right? You've worked very, very hard for that. And we just don't want you in a situation, again, where, you're losing any portion of that if you don't have to. Even if it's for, just with that little taxable income. Again, it's not like your IRA is going to be distributed to you or penalized. You are just going to be taxed like any other business would. It's just something to keep in mind. Again, you still might find that it's an investment that makes sense for you. You might not even have that type of money outside of your IRA. So maybe that IRA is the only place you can make that investment. These are the types of things you want to consider, when you're deciding which bucket of money you want to use. And then, of course, with the extra rules that come with self-directed IRAs, if you're going to use the IRA, how to use it properly, right? So again, in fix and flips, you could also use a loan. So you want to keep that UDFI tax in mind as well. But number 4 is a special warning, and this is a reiteration of the prohibited transactions. The IRS, again, to reiterate, doesn't want you buying, selling, loaning, trading, or extending services to your IRA or your IRA's investments. And what that means for fix and flips, what that means for real estate in general too, is that the IRS doesn't want you to put in any sweat equity. You are, as the IRA owner, supposed to, if you're going to contribute to your IRA, that's going to be your yearly contributions, right? The IRS, they view sweat equity. They could view sweat equity as an excess contribution to your IRA or an extension of service, as previously mentioned. So just keep these things in mind. Fix and flips, they're arguably the most active type of real estate investment, in my opinion. Does that make it the best fit for a self-directed IRA? Maybe not in comparison to other things, but if you know the rules and maybe you consider yourself a really proficient fixer and flipper, you got a good network, you can outsource the things that would make it be prohibited for an IRA or might make it taxable for an IRA. There's ways that you can structure it to make it work, but we always just want to let you know what to expect, put everything out there so you can just be the best educated self-directed IRA investor you can be. So moving on from fix and flips, we're going to talk a little bit about syndications. We're going to take quite a swing back in the other direction. Fix and flips are a very, very active real estate investment type. Syndications, on the other hand, are almost as passive as you can get. I'd say almost the most passive you could get. So what is a syndication? It's a weird word, but what it means is that a group of people somewhere out there got together. They maybe formed an LLC, an LP, and they're trying to raise money from investors so that they can go and invest in large scale assets, real estate related, typically multifamily, like commercial multifamily, like apartment buildings. And the investor, they're just getting paid, month after month or whatever the terms of the investment are, returns on their money. And at the end of the period, usually syndication deals are anywhere between, maybe 3 to 5 years long. There might be a payout at the end, however it's structured, right? You always want to make sure you know how the investment is structured. But they are usually real estate related, right? There are syndications that invest in other things, but whether it's commercial real estate, residential real estate, there's a lot of syndications out there, and they're not even just limited to real estate either. Now, the reason why an investor might choose syndications over something else is just, number one, how passive it is. You don't have to do any of the dirty work that's associated with owning a rental property or operating an Airbnb. Operating an Airbnb or doing a fix and flip. This is very, very different, very starkly different, because all you're doing with your IRA or with your personal cash is essentially being a money partner in a deal, and you're just collecting the returns on a monthly basis. So as far as how do you find these opportunities, it's really, really a networking game. Syndications are typically private deals, so you either have to know someone or just know where to look. Now, of course, knowing where to look may be easier said than done, but you'll find that I always come back to this as a solution, is those local RIAs, those local real estate investor association meetings that might be nearby you. They're always in some major city, especially in the hot real estate markets. But those are the people that you want to talk to, because they might know of a syndication or they could be starting one themselves. You just never know. So that is how you stumble across these. There's also podcasts out there where you could do a simple search on Spotify or Apple Podcasts for syndications, real estate syndications, and you can get exposed to these people. They're likely ones that might have some requirements to invest with them, which is where we'll get into things to consider here shortly. But it really is a networking game. That's the world of alternative investments. The good news for you, though, the self-directed investor, is that it's the year 2022, and I think it's probably the easiest time right now to network. So start. So just to get into the things to consider and keep moving along, is investing with this entity limited to accredited or sophisticated investors? And this, when you're looking at these offerings or at these syndications, this is where they might make the might specify whether there's something like I think it's like a 503B, 503C, or 506, numbers and letters. You know what it is when we're talking about SEC related stuff, anything IRS, it's a lot of numbers and letters. But the important part is that a lot of these syndications might be limited to accredited or sophisticated investors, right? You might have to have a certain net worth, certain amount of time in a related field. There might be certain qualifications, but there are also opportunities out there that are not limited to accredited or sophisticated investors. So get out there and start networking, find out where those opportunities are. Now, number two, will the investment trigger UBIT or UDFI? And the answer is almost always with syndications, because there is almost always a form of leverage being used in form of bank financing. So more often than not, you can always expect there to be some type of UBIT or UDFI in a type of syndication investment. Number three, it's a little bit more unique for syndications because the terms of the investment aren't really dictated by you. So you do want to make sure that you know what the exit plan is. Will you be able to liquidate at some point during the lifetime of the investment if you wanted to? You know, how long is the terms of the investment, since it could be up to 5 years? And, you know, very starkly different from fix and flips. You know, 3 to 5 years is a long time to have your money sitting in one spot before you can redeploy it again. So it is something to take into consideration. When we talk about notes for self-directed IRAs, again, it's that, you know, prohibited transaction, disqualified parties. What that means for syndications, though, is, you know, if you have somebody in that lineal ascendant, descendant, or a beneficiary that's a partner on a syndication, one of the main people that's, you know, pulling the strings, you likely will not be able to invest in that syndication due to the rules, you know, that govern self-directed IRAs. And that's, you know, again, just not the investment for your self-directed IRA. If you can do it outside of it, by all means, if it's a good investment, it's a good investment. Now, also with self-directed IRAs, we do, in some cases, like with traditional IRAs, SEP IRAs, simple IRAs, or even 401ks, we do have required minimum distributions that we have to be aware of and that our clients have to be aware of. So if a client is at, you know, sitting at 71 years old, okay, and they've got a traditional IRA and it's fully invested into a syndication, right? And that syndication doesn't fully pay out until 5 years in the future. Well, that client is going to start having to take required minimum distributions at 72. And if they didn't figure out ahead of time if they'd be able to pull money out of that syndication deal to be able to satisfy those RMDs, they might have to start paying penalties as well if they start taking their RMDs late. So that's something very important to consider with syndications if you're going to be doing those types of investments in a self-directed IRA. Again, if you're around that age where required minimum distributions might come into play. So next up, we got unimproved land. And this is, again, one that is very, very passive. And this is a very simple investment because you're literally purchasing land with typically one of two goals in mind. You're either just going to sell it later after it's appreciated and you're going to sell it to somebody that might develop it or just another investor, or you're actually going to develop on that land yourself. Now, this is, depending on what your approach is, whether you're in the development camp or if you're just going to sell it after it appreciates, it is, still a bit of a speculation play because this is still unimproved, undeveloped land. It would be, a new community, or you're just speculating that, somebody else might want to come in and think that it's, worth more than what you paid for it. There's no cash flow aspect to it, which is why it's different. But a silver lining to that, well, you'd say, well, gee, I look at real estate and I want the cash flow from it. Well, I was introduced very recently to an idea called land banking, which is essentially investing in undeveloped land. What this strategy really entails is having some good resources, having a good idea of future development in an area so that you can very strategically buy a plot of land that developers are going to come barreling through in a year or two because the population's growing. And that if that does occur, again, it's very speculative, but you have an idea that if that occurs, that value of that land is going to increase very, very rapidly if that were to occur. So that is something to think of too. It was a very cool idea that I was introduced, and it does make sense. Once people come in and they want that land or they need that land, that could be a very fun negotiation going back and forth. Now, going into the why a little bit more, the low barrier to entry associated with unimproved land is also a very interesting characteristic, something that new self-directed investors might look to get into, somebody that's just started a new IRA, or even just somebody with limited capital, is because you don't need a ton of money to buy, an acre of land. It's not a developed property, there's not all that other associated, value there. So in comparison to buying a full-blown rental property or an Airbnb or, fix and flip, or, even investing into syndication, a syndication might have a $50,000 minimum, whereas, buying a piece of land might be as cheap as 10,000. So the barrier to entry is drastically different, although the outcome, the why, what you're getting for your investment is very different. So again, compare everything together, see what makes you the most comfortable, what you're the most interested in. And the how for unimproved land, again, it's very simple. It's that locate, evaluate, inspect, act, and sell the property or develop on it. I should have put that little asterisk down there, because you could essentially develop the property as well if that is your goal. Now, things to consider, again, getting relatively redundant at this point, but the location is important. And in this case, important because you want to be buying land, or, maybe buy land in an area that's just got good things going on around it from a community, from an environmental standpoint, something that, is likely to maybe have some population growth soon, just to know that, you've feel like you've made a good deal. You've negotiated the best possible price once again. And now you're just, sitting back, waiting for development to occur, or, waiting to do the development yourself. Like I said, because there is that other side of the approach when you're investing in land. So that's number 3, it's basically that question. Another, thing you want to notice though, or keep notice of, is zoning laws. So similar to Airbnbs, there might be areas that you can't construct on a piece of land, or you can't construct the way you want to. You can't put the type of establishment or the type of building, sewage, you can't run electric out there, water, there could be things like that occur. So you do, again, maybe it's finding a real estate attorney that can help you, guide you through asking those questions. Maybe it's not paying for a real estate attorney, but just going to one of these real estate investor associations for, maybe a $50 fee, first time visitor. It could be that easy. Somebody might have the answers for you there, or at least point you in the right direction. Right. So again, UDFI, prohibited transactions, disqualified parties, it all applies in the same way. Unimproved land, it's not like, you can, a disqualified person could rent it, because you're not going to rent unimproved land. But this would be an instance where taking indirect benefit from that land, something like using that land to camp on, go hunting, that would be considered inappropriate or prohibited for a self-directed IRA. So please keep that in mind. And if you ever have any questions about these two, whether or not something might be prohibited, or, defining disqualified parties, always give us a call. We're happy to, give you our best understanding of how it might relate to what you're trying to do, and always try to just prepare you as best we can for, for what you got going on. All right. Lastly, we got offshore real estate. And this is one that not a lot of people even think of right off the bat, because they just know what's in their backyard, or what's in their state or their region. Offshore real estate, it's any type of real estate investment essentially that happens overseas. Most oftentimes we see clients do Airbnbs that might be in Cancun or over in Spain. The important part being, though, is that they're just taking advantage of what might be developing countries, tourist hotspots. There might be a higher return on investment potential, how powerful the dollar is in some countries. So that's kind of the advantageous aspect of offshore real estate that a lot of NuView clients look at. And depending on their style of real estate investing, they might do it through single or multifamily rentals, Airbnbs, maybe buying land. It could be a lot of different things, or for a lot of different purposes. We do have clients that invest in agricultural land overseas as well, where, the investment isn't necessarily tied to the agricultural product itself, but those who are harvesting the land are essentially renting that land, renting that offshore real estate from the IRA. And that's how the IRA makes its money. That's how that NuView client's IRA is growing over time. And they're just not doing it within the United States. They're deciding to invest offshore. Like I said, the dollar purchasing power might be a little bit greater. Just something to keep on the radar. Just something if it interests you, it might be worth looking into. And the steps, the how, this is where it gets a bit interesting, because offshore real estate, oftentimes in certain countries, they won't allow for an IRA or a US entity to directly purchase or directly invest into a property there. So what we have clients, or I'm sorry, what we tell clients to do, and what other clients have had success with is, they might establish an international business company, an IBC, which is very, very similar to an LLC. And what they're doing with this IBC is they're having their NuView IRA invest into that IBC, and that IBC is now essentially a pass-through for their IRA. Now that IBC can go to that other country, establish a bank account, and ultimately invest in that rental property. So it's a couple extra steps. It's a little bit funny when you start, putting all those moving pieces together, but the ultimate goal, it still can be accomplished. And, I'd probably say you probably can't invest in North Korea. Something tells me that they won't even accept IBCs there. So just keep that in mind. Life insurance contracts, collectibles, and offshore real estate in North Korea, probably not going to happen. So with offshore real estate, just like Airbnbs, you do either, have to be, I can't say that you just have to outsource a heck of a lot more. There's no real way, unless you're going to be living overseas as well, you've got to outsource a heck of a lot when you're doing offshore real estate investing. Who's managing the property, all that. And it's stuff to take into consideration. Just like all the other thing we have here, especially the special entity, do you need to establish one of those? Who's going to be managing it? And then all the other usual questions you ask when investing in real estate. For self-directed IRAs, like I said, that IBC component, having to set up a pass-through to allow you to invest in that other country is going to be important. So again, these ones right here, the ones I've presented, this really is kind of like the top 6 that NuView clients are either investing in, interested in, want to learn more about. And for the new investors out there too, like I said, go back to that investment types 101. That's got even more on the topic of real estate. I know one of the first slides here did have pretty much everything. I underlined the top 6, and that would definitely be a good place for you to start. So just to recap, we talked about this a little bit in investment types 101, is what does real estate look like in a self-directed IRA? We don't do anything without your written authorization. We still need to sign off on your investment paperwork as the IRA custodian. So what we request from you is the completed purchase packet for real estate, which you see pictured there. It's a 1-page NuView worksheet where you give us investment details and where we're going to be sending the money. But we'll also need a copy of any supporting documents for the real estate investment, like the contract, the title, really anything that comes at closing as well. So the warranty deed, the settlement statement, anything else that you got, we require it, and we're likely going to have to sign off on it as the NuView IRA custodian. Now, if you're investing offshore in a syndication, this is where this process is a little bit different. Like I said, for offshore real estate, that IBC, that entity is what your IRA is going to invest in first, and then that IBC is going to invest in the offshore real estate. When you're investing into syndication, your IRA isn't going to be the direct owner of that commercial apartment complex. You're just one of 100 investors involved that are investing into a limited partnership or an LLC. So the way NuView processes that type of investment is through our private entities investment team. And what they're going to require is a purchase packet once again, but this time it's for private stock. It's going to be a little bit different details that you fill out, but what this is instructing NuView to do is invest your self-directed IRA funds into a business entity like an LLC or an LP, and you'll also let us know what the expected returns are for the investment. And you'll have to also provide whatever supporting documentations that the syndication has provided you. This is usually in the form of an operating agreement or a subscription agreement. Of course, wiring instructions, we need to know where we're sending the money, but this is just to give you an idea of how these types of investments are processed at NuView, right? Always, when you're approaching these opportunities, whether it's a seller of a real estate investment property or if it's an investment sponsor of a syndication, always make sure that they know to vest it in the name of your IRA as well. Just a little something I want to add just because it's very, very important. Again, I'll reiterate, it's not you that's making these investments, it's your IRA. So it needs to be that IRA's name, NuView Trust Company, FBO, your name and account number, that shows up on all these investment documents. Making sure to get that done the first time and getting it done the right way will save, a lot of back and forth, trying to get forms, corrected back and forth and ultimately get those funds out, because we know in the world of alternative investments, there are some deadlines sometimes, and we want to be making sure that we're in the best position and you're in the best position to make those investments possible. So always, 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 if you have any questions, reach out to us. I do want to say thank you for joining today. I know it's just after 2 o'clock and everybody wants to get back to their Wednesday. I did have a handful of questions here, so I'm going to go over to this contact slide here. If you got a scram, if you've got questions, shoot us an email. But for everybody else, if you guys want to hang out for another couple minutes, I am going to poke through this Q&A that we got here. And if you guys have anything that you want to add, anybody that came in a little bit late, if you have questions, feel free to throw them in as well. Melissa, for Airbnb, do you have to pay UBIT for their Airbnb? This one is, like I said, it's a gray area with IRAs. The issue is that the IRS doesn't give us a finite number on the terms, the length of the stays that might trigger UBIT. It is just one of those things where playing it safe would likely be keeping it a week plus on those rentals, making sure that you're not having people come in every single night, somebody different, 7 bookings a week. Like I said, talk to the tax professional, maybe somebody that's familiar with self-directed IRAs. We do have resources for you too. I don't want you to feel like I'm just saying, go talk to somebody and not point you in the right direction. Melissa, if you want to send us an email, we can definitely get you some contact information for probably one of the more forefront self-directed IRA CPAs that will be, very clearly able to answer that question for you, at least maybe clearer than I can. All right, Christian, what are the mechanics of funding the renovations of a fix and flip after the house is purchased? If your IRA buys land and I want to use non-IRA money to build on it, how does that work in terms of ownership? All right, so we'll attack the first one first. What are the mechanics of funding the renovations of a fix and flip after the house is purchased? So the mechanics, it's still all got to be through NuView because we are the custodian of that IRA. That's where your IRA funds reside. Any expenses for an IRA owned investment, so for real estate or for unimproved land, the construction, it is considered an expense for the IRA if the IRA is a 100% owner of that property. If the IRA is a 50% owner of that property, then they would be responsible for 50% of the expenses. Now, that being said, there are instances where if you, like you said in your second question, if you wanted to use non-IRA funds to build on it, you wouldn't be able to fund the entire construction with non-IRA funds, but what you could do and what a lot of NuView clients do is they'll maybe have joint ownership of that piece of land between themselves and their IRA. Easy number's sake, let's call it 50-50. And they'll be 50-50 owners of that land. So when construction comes along and there's development that needs to occur, IRA is responsible for 50% of the expenses, personal cash is responsible for the other 50% of the expenses. So Christian, I hope that answers your question. Definitely shoot us an email if you want further clarification or give us a call. That's all I've got for questions at the moment. So I am gonna wrap this up with our little fancy stay up to date with us slide. Scan the QR code. It'll bring you to our website, our educational resources page, where you can see an archive of all our past webinars. You can go check out that investment types 101 if you want a little bit more as far as the different types of real estate out there. This one, I really wanted to hone in on the ones that NuView clients are doing the most or the most interested on. And it really is just a good resource as a whole, that educational resources page, really just to open your mind to what else is out there. Any of the past webinars we've done, if you scroll down and you see the one by Adam Barr, CPA, he really goes very, very in depth on UBIT and UDFI if you want some more clarification there as well. But guys, that's all I got for today. I think next time for a solo one, we'll go into the next category of investment types 101. If that sounds like a plan, hope to see you guys there. Otherwise, have a great rest of your Wednesday, and thanks for hanging out.